Hello, my name's Doug Lennick. Welcome back to Smart Money Moves for those of you who are back, and welcome for the first time for those of you who are joining us. I'm here with my co-host Adam Recker. As you guys know, he's our senior director and he's the head of equities here at the Mather Group. And we have Tim Ailes with us today too. He's an investment director here, and these people are going to help us think about what the heck is going on. 2026 has been quite a year. Probably today has been quite a day. I don't even know. These guys will talk about that. But we've got ongoing market volatility, obviously geopolitical concerns. People are expecting one thing and they're getting another. Interest rates, inflation, we don't know what's happening. But the market's moving is only part of the game. What do people do with all that movement? How do we behave? What's our story? What's your story? And we're going to hear and talk about that today. So you've got Adam and Tim are here. Let's talk about what's going on right now. Let's jump in, Adam. What do you got?
Uh,
And welcome, by the way, Tim, to our show. So Adam and I are happy to have you here.
Thanks. Yeah. Yeah. Always a lot going on in the market, a lot of headlines, a lot of volatility, as we're well aware, over this year and the past month. But fortunately, over the past month, things generally positive. As many are aware, going through our past conversations this year so far, fairly calm start to the year, but then fairly big pullback back in March, as we'll show and talk about with a couple different things here today. Um, but really over the month of April, strong recovery across the board, both U.S. internationally, and markets really back at all-time highs, despite all of the geopolitical noise and the like going on, which there's a lesson in there. Even today, saw a little bit of choppiness, some questions. Jerome Powell had his last meeting as Fed chair, holding rates steady, and so obviously the market trying to figure out which way things are leaning adds to a little bit of volatility. But in the end, really the market ended pretty much flat. Now, speaking of volatility, as we've shared multiple times, but I think is always good to revisit, it's ever present in the market. Looking back over past years, past history, even in very good years, we expect fairly sizable drawdowns any given year in the market. And again, this year was like any other so far, where we've had a decent pullback, but you fast forward through that pullback, we're back at all-time highs. And so a big lesson throughout the course of today really is the story. Everybody has data that they're interpreting in the market. There's headlines, people competing for eyeballs. Ultimately, it's important, how do we actually interpret that data and how do we act on it or not act on it? And what's the best?
Well, it's interesting as you say that the data, in theory, that everybody gets access to the same information. That's not necessarily true, but in theory, we have access to the same information. But what you're also saying is what we do with that data is different. And so our humanness comes into play. And this is where our story matters and our own biases and all that start to matter. It's that human factor. And I appreciate you saying that. Thank you. That takes us to
Maybe through the next slide. So,
the headlines. And this, by the way, is really interesting because you were just saying this, Adam, that the headlines are sometimes saying one thing, but what's happening seems to be different.
right. And so this is where I think Tim, we want Tim to jump in. I mean, he did a lot of work as questions with clients throughout the day, throughout the month, and is navigating these things too. So go for it, Tim.
Yeah, so this chart is just a good reminder because when we're trying to think through investments or what our future looks like through headlines that we're reading about, it creates different types of emotions in which we might do things we're not, that's not in our best interest. So this alone shows that we had this massive rally after all this geopolitical news. If you looked at just the headlines would have argued there's no way that type of a rally, really a record-setting rally, would have ever been able to happen. And when you look at this orange dot here, it says on April 7th, there's a 2 week ceasefire that was announced, but before the ceasefire was even announced, the market had already moved almost 5%, which when you look at a typical historical S&P 500 type of return, that's almost a half a year's worth of return before anything was even announced yet. So you move forward in a matter of 13 days, the market from the low all the way to where it went to the April 17th close was literally 1 year worth of stock market returns that could have been missed for an investor who was reading the path of the market based on what they were seeing in the headlines, good, bad, or indifferent. So that's what this shows you. You can't anticipate when that rally happens. And this was a record-setting rally that you could have missed had you let the headlines drive your decisions.
Well, and headlines often do. And what's happening is the same information will make different ones of us emotionally feel different.
Yeah.
And one of the things that you've mentioned, you kind of call into attention the concept, the notion, the emotion fear, and what people do when afraid. And one of the things that we've said on, I think, on an earlier show, but when our emotional intelligence for all of us watching today, please remember, emotional intelligence is real, but it is not cognitive. And so the way to think about that is a bear market often scares people. It's scary. Bears in the woods scare you. Both bears are scary. But our emotional intelligence actually can't tell the difference between the bear. An irrational response to encountering the bear is to run. You know, when you run from the bear market, you lose your money. When you run from the bear in the woods, unless you're running with me, you are going to lose your life because he's faster than you. So I think that's an important point. I really appreciate you saying that, Tim. And it's really about this, what you guys are here saying here.
Yeah, so on this slide, one can always create a narrative as to why the market went down, why the market went up. And here's just some different examples of things that took place. Oil price dropped 10%. There was strong bank earnings. Semiconductor stocks were really strong. And when geopolitical news or fearful news starts to enter into our purview, we get really focused or myopic on that one thing alone. Maybe it's the person who was elected isn't who we wanted, and we get focused on that one thing. And the reality is there's a lot of other information that's going on that also matters. So you think about COVID, for example, you're focused on COVID. Well, people who were fearful about that and wanted to get out of the market weren't taking potentially into consideration the amount of money that was coming into the financial system through PPP loans, et cetera. And those inputs really impact what happens to the market as well. So in the same way that we wouldn't want you to develop your long-term financial plan by owning one stock, diversity matters. Rather than getting myopic and focused on a scary headline, realize that a diversity of inputs like bank earnings or like international markets or other things that you may not be considered do matter. And I think when fear takes over, we get that fight or flight mentality and we get real myopic, which can really damage or hurt us in the long run.
Well, and what you guys are doing every day is taking into consideration what you just said. And it allows for our clients to actually know, hey, somebody is doing their best to take the emotional element of this out of our equation so that we aren't doing the wrong thing at the wrong time because it's behavior that oftentimes results in investments working better than investors. So we want to guard against investments working, investors not. And that's what the Mather Group is here to do. And that's what our investment people assist the wealth advisors and everybody in making sure happens. So I really like this particular slide. Thanks for this one. All of them. Next.
And I'll jump in on this one as well. This is just a chart that shows, if you look at the dotted line, this is S&P 500 earnings. And what you notice is the stability of the earnings, they're going up. And it's pretty consistent year over year. And that's been true for decades. What's not consistent is the prices of the stock market, and that's driven by fear and greed. And one thing that we do know that is consistent and will continue to happen for decades, we can guarantee that humans are going to be impacted by fear and greed. That's a guarantee. We're emotional beings. So while earnings continue to go up and stay steady, humans who are making buy and sell decisions are creating great opportunities. So here at the Mather Group, it's not that we're afraid of volatility. In fact, I look at volatility as a good thing, because when investors get overly excited and want to pay us more than what maybe a stock is worth, that's a great time to rebalance and sell that stock that got overweight. Let's go ahead and sell that stock to those people who are being greedy. And likewise, when they're being fearful and they just want out at any price, that's a great time to step in and take advantage of that fear and greed issue and say, oh, you know what, let's buy that stock. So prices moving around in a volatile manner is it's a good thing. It's a welcome thing for a long-term plan, because we want to be able to buy stocks low and to sell stocks high in the form of rebalancing.
Well, and I like, by the way, we've talked about the fear and greed before, and a colleague of mine that I've known over the years, professor, has written the book Beyond Greed and Fear. Hersh Shefrin is the name. You probably have read the book. But one of the things I like about this particular slide talks about positioning and allocation matter more than prediction. And what we are really providing for our clients, what we're interested in here is preparing. So if you think of positioning and allocation, substitute the word preparation. Preparation matters more than prediction. What we do is we will prepare clients for the truth. The truth is uncertainty. We don't know. We talked about that at the outset of the show. This is uncertain times. So we're not predicting we know what's going to happen. What we're suggesting is it's in our best interest to be prepared. So there's others who are in the prediction business. That's not us. When I get pushed on it and they say, "Come on, Doug, what do you think is going to happen?" I will go out on a limb and I will say I predict fluctuation. I think we're going to see some fluctuation. So and we do. So I've been right about that. Any comments you would add to that, Adam or Tim?
I would say JP Morgan said the same thing. I think that's who it's attributed to. So if it's good enough to get your name on the building, it's probably good enough for us too. But I think you hit it right on the head. And we've got an exact example of this, I think, on the following slide, really the difference between, investing through more of an emotional lens or feeling a desire for safety, which I think depending on the client, like in your, again, back to your story, some just by the way they grew up, life circumstances, things like that, may cling more to a desire for safety. And that's not inherently wrong. It's just you have to
No.
account for some of the stuff ahead of time through your overall risk positioning. You don't want your safety after the pullback has happened. You prepare for it. On the flip side, some want to be more aggressive, but I think in this case that Tim, I think, put together here kind of captures it nicely, the difference, the same information, but getting different outcomes by being prepared versus not being prepared. So, I mean, why don't you keep taking it, Tim?
Well, just to focus on that third row, the reentry timing, it states there that this investor waited for clarity before getting back in, whether it was a ceasefire, a deal, oil price back down. But again, that investor waited for clarity but missed the rally. That's when you think about it in terms of numbers. If I came to you and said, "Hey, are you willing to pay $100,000 for 2 weeks of clarity?" Usually the answer is going to be no, right? But that's what emotions do. We don't oftentimes put a price tag on the emotions just to feel good. So the investor who didn't wait for that clarity and had a plan, as Adam was talking about, how are we going to attack volatility when it comes into a portfolio, do we have a plan to take advantage of those prices? Those investors mathematically, academically, always end up doing better, just because the emotions are not part of the decision process. It's all plan driven and sticking to that plan. It's hard, right? I'm a human as well. I know all the right things and I feel the same emotions that you do, but we know well enough to stick to the academic research because that's going to always trump how we feel in the moment.
Well, I love what you're saying here. This idea of timing. One of my former colleagues, Ted Truscott, who works with now, hundreds of billions of dollars, I quoted him in one of my books, Financial Intelligence. He said, the thing about it is when you have the price, you don't have the proof, and when you have the proof, you don't have the price. And he added to that, and most everyone's wrong at the turn. It's hard to pick the exact bottom and the exact top. But what you guys are saying is you can be prepared for it to go up and down because it will in a generally upward direction. So I find that really helpful. And it shows up in decisions. So comment on that.
Yeah, I mean, I think we established it. I mean, everybody has their own story, the way they interpret the data. Stories are really good at getting people to act. There's nothing more powerful than a story. We just want to make sure we're listening to the right stories and are framing it in a healthy manner to make good decisions so that the story itself has a happy ending. And with enough preparation, we're very confident they all have happy endings.
Yeah, I like, well, and again, that word is really critical. And something again that I also want to add, I'm pretty sure everybody watching this show knows that the Mather Group is a fiduciary company. And that is, of course, obligates us legally. We're also good people. So even if it wasn't a requirement, we want to act in our client's best interest. But where we are pushing this is where we really work hard at getting our clients to act in their best interest. And sometimes that's not easy because of our various biases. And the smartest of us can have some of the most difficult times. Not that I'm the smartest of us, but I have suffered from overconfidence and excessive optimism. I need a balance in my life. And I'm a confirmation bias guy personally. I like information that confirms my point of view. I don't know if any of you are like that, but that's me. I mean, I'm like that guy. I know what TV shows to watch so that I can hear my point of view. And if I'm willing to be irritated, I know what TV shows to turn on. And sure enough, they'll irritate me in a nanosecond. And I think all of us understand that about ourselves. And what we're doing is taking that to how we make financial decisions so that people can make reasonably smart, responsible, values based decision with their money. So, where investment decisions break, talk about this. You have, I guess.
Yeah,
Keep
no,
doing it.
I would say as I was reflecting on what you said, Doug, I mean, I think where do they break? I mean, I think part of it though is like an advantage is being aware of the limitations for one. Like you can't address something until you're aware of it in the first place. And so, like you said, you have your biases, I have mine, but we recognize it and so we can act on it. Absent that, you're more likely to overreact to short-term events because it's not being framed properly or losing sight of what the long-term objective is. Like, why did I choose this plan in the first place? It was to achieve a certain goal. Why should that goal change based on what's happening with somebody else in my orbit? Like, stay focused on your own plan because that's what matters. And a lot of
Yes.
times, the people outside the orbit, they're not exactly being truthful with what's going on either because they want to look good. You know, nobody ever talks about their failures. They usually talk about their successes.
Mhm.
And so, make sure everything's coordinated because I think, like you had said before, we don't need to time the market perfectly. Like it's not necessary. And so you don't want
No,
to be getting out of the market. I think a slide we had pulled, a kind of a newer version of the same concept on the following slide. Even if you look at the biggest pullbacks we've had throughout history, some very, devastating in their own right. And again, admittedly, not everybody has an infinite timeline to recover from everything, which is why you don't take on too much risk on the front end, and you have safe assets if you need them over the near to intermediate term. But long term, the markets recover, and they generally have pretty positive returns, even following the absolute worst timing before major, major pullbacks. And again, the odds of getting perfectly wrong are not very high either. It'd be very, very unlucky. But even if you're
right.
the most unlucky person in the world, you can still have very good outcomes.
Well, I really appreciate what you're saying, and the whole, and it's interesting as I look at this particular chart in my own career. I started, so this dates me a little bit, but I started my training during the oil crisis. So I became personally an investor at age 20 in 1972, and then I went through licensing and started getting into the business in 1971. Now, this will be fun for everybody to hear. 1972 was the first year that the Dow Jones closed the year above 1,000. 1,000, the Dow. The next year, the Dow closed above 1,000 was 1982, and it closed in 1972. I think if I remember correctly, and I'm almost certain I do, it closed at 1,020, and then in 1982 it closed at 1,047. And I like to say it didn't go straight up those 27 points. It kind of zigged and zagged over those 11 years. And I of course remember Black Monday. So all of these things, uh, we don't know when they're going to happen, but we know things are going to happen. And so what we do is prepare ourselves and our clients for the uncertainties. We don't predict the future, we prepare people for it. And that's kind of fun. So that whenever you need money for whatever the reason, then there would be a smart place to get it. That's the concept. I like this a lot. Thank you for this one. And I like the next one too, so we might as well.
Yeah.
I like to call this chart the cost of feeling good when things are scary, right? So this is a $10,000 investment. Sticking the green here, it's just staying fully invested through the ups and downs. Um, the next bars, the yellow and the red bars, are if you missed the best days. Now, usually the best days are clustered around the more volatile parts of life in the economy. So whether it's a war, a COVID, the market's going to be volatile to the downside. At the same time, some of the biggest and best days are to the upside in the scariest moments. And if you decide that you wanted to step out and wait for things to get better, well, this is the cost of feeling okay when it comes to headline driven investing. So $10,000 investment over 30 years, just sitting through it turns into 112,000. If you miss the best 10 days in that same period of time, you lose over 50% of the gains you could have had. And this is on $10,000. So if you have a $100,000 account, now we're talking about $510,000. $1 million account, we're talking real money just to feel good for 10 days that you would have missed waiting for the news to get better. So that's why I wanted to put a dollar number to feeling good and realize that that's not a good plan. Having a plan based on math, based on academic research, knowing when to rebalance, and almost inviting the volatility to come so that we can do the things that TMG does well in those moments to really set your plan up for success over the 30-year period. It has nothing to do with emotions.
Well, and by the way, I don't know if this is okay to say, but I'll say it anyway. One of the things that I've come to know over the years is there are some people in this industry that will get the investor to buy or invest in what is emotionally easy to get them to do. And what is emotionally easy to get one to do is not always cognitively smart. And so we want to be aware of that. And you've said it really well, Tim. This You don't want to be out. Now, this does not say we're all in either, because we're prepared for needing money and the market being down. So if the market's down and I need money, we take it from things called cash. It's like that. Any comment you'd add to that?
Well, that's a great point. And this is just looking at the stock portion of a well-diversified portfolio. And it's also just looking at the S&P 500. So we have a global portfolio when it comes to the stock portion, but then you do look at the bonds and you do look at the cash, and those all come into play. And it's going back to the concept of rebalancing, right? So when the volatility enters, the market goes down more than feels comfortable. Well, we have this other portion of the portfolio that we want to take and to lean into that volatility and set yourself up by buying those stocks while they're while they're down for the long-term performance. So the numbers look even better when you start to think about a diversified portfolio in regards to why you don't want to be out of the stock sleeve or the stock portion of your portfolio just to stay safe. But this is just looking at the S&P 500, not the global aspect for sure.
But the very important point, you don't want to ever be out of the stock sleeve.
Right.
Right. I like it. And this I love. Adam, let's go with this one. This is a great little chart. And this speaks to what all of our clients have come to expect from us and what those of you who aren't would get joining
Yeah.
in.
Yeah. So
Talk
again,
about
talking about preparation, coordinated plan. What's a good plan look like? There's levels to it, I think. And as we tend to share, and I think we try to highlight this by not only putting an entire team around every client we have, but bringing subject matter experts to the table in venues like this, being very accessible. It just goes to show like a strong foundation is built on having all of those things, the financial plan, investments, controlling risk overall, estate planning where applicable, speaking to cash flow, like all of that is necessary. And it's often done much better when it's all integrated together and everybody's talking together, opposed to trying to piecemeal and have differing perspectives that may not be conducive to working together. Um, but we want to take that further. Or go ahead. Go
this
ahead.
is really a big part. The word in there is synchronized, but the whole thing is synchronized. The tax synchronization, but it's the integration of everything that really matters. And it's what's the song? The leg bones connected to the wrist bone or whatever it is. It's if we understand that and apply that here, what we're doing with one part of our overall financial life will influence another. And if we understand how that is done, we can coordinate that and integrate that in an optimal manner. And what I have seen these guys do, because I'm not the guy who does it, what I have seen these guys do is just exceptional. It's extraordinary, both in the tax strategy side, where you really have real alpha that doesn't require the markets to do anything. And then when you get into the investment strategy and the awareness that these guys have to be prepared for the flows. So, key takeaways, here we are. Markets will always be uncertain. Do you agree with that, Adam and Tim?
Uh, that's one thing I'm more certain about than anything. So,
Yeah, this makes me feel so good about my prediction that the market will fluctuate.
yeah. And
I-
so again,
I-
going back to it, you can plan for it. You can't predict exactly what's going to happen or the magnitude. You can have a sense of maybe direction long term based on underlying fundamentals, but we need to make good decisions day in, day out, integrated plan, even periods of volatility, as Tim shared, whether it's rebalancing, that presents an opportunity, tax strategies become more applicable, more powerful in the midst of volatile pullbacks, as long as you are prepared for it. Again, smart money, you need to pay a Roth conversion tax. Well, you need the money to pay it. Make sure it's safe and you have it kind of earmarked for that goal, because then it makes that maneuver possible or more powerful. And so it's that coordination, being able to talk with you, be able to talk with Tim, be able to talk with even like Michael Kowalski from the tax team on the last call. Um, Work with the wealth advisors, you know, their clients the best. Like that's where the good outcomes at.
Well, I think I hope I'm not sure, but we'll talk amongst ourselves. But we might just bring a wealth advisor on next time. But we also have some special guests in our back pocket that we're going to be bringing your way. So we want to say thank you all for joining us. I can say we because Adam and I do talk about this, and Tim now joined us. But we really look forward to sharing these thoughts and ideas with you and doing everything we can to get you to act in your own best interest. Thanks for joining us. See you next month.